Good day, investors. Today, we are looking at the Canadian agribusiness, Nutrien. It's a global fertilizer and ag retail leader, but its performance remains highly cyclical and tied to volatile prices around the fertilizer market and, of course, input prices around energy. While scale and integration offers some cost advantages, I don't really see pricing power and a strong moat at all. You would see that looking at the return on investment, which is relatively poor. They have experienced leadership with sort of good capital allocation policies, yet I don't see a clear, transparent incentive structure, and the timing of those decisions could be questioned. So we'll see more on that later. And on the margin of safety side, I think the company is a bit overpriced, and uh, they have a low coverage ratio. So I think the interest payments could be an issue going forward if they don't fix it. So it's a global leader in crop inputs, right? So potash, nitrogen, phosphate, and general ag retail. The company doesn't have a big shareholder like many we have covered on the channel. They don't have a big skin in the game player. It's more like just pension funds and asset managers who hold this. They have exposure to, of course, fertilizer prices, which is a commodity, so they are price followers, and input costs also can hurt the business margins. Their focus is, if you are a commodity business in general, on efficiency, portfolio optimization, and meeting the general rising food demand. So they are also investing to follow the market, as you will see. Their main segments, according to year-to-date numbers on their 2025 quarterly, is retail, potash, and nitrogen. As you can see, these are adjusted EBITDA numbers, so if we would see numbers on a free cash flow basis, it might look a bit different, but this gives you a picture. And on the global profile, I cut together two slides so you can see they are relatively well diversified. They have most of their businesses in North America, but also present in Brazil, Australia, and some Europe only has distribution, right? And the JVs in China. But most of the retail and potash, so these are in North America, so Canada, US, Australia, Brazil, and Latin America with some other areas. So in general, the trend for potash and actually other markets, so I just took potash, but you could basically map the same for nitrogen, is that you have a general growth on everything, right? Because you have a growth in population globally in general, and you need to grow more crops. It's not just crops people eat, right? You probably want to use nitrogen fertilizers on crops that animals eat, and animals eat relatively more, right? So if you are getting wealthier, so look at China, it's a clear picture. China, the population has been dropping since I think 2022, so you would expect demand to be dropping, but no, because the country getting richer, so the quality of their food is getting richer. You eat less rice, you eat less grains, you eat more meat, and those animals have to be fed as well. So you have a slow growth in general for demand for these agro-business products. On the Moat side, um, technically they have an integrated model, right? So they have their own production and large retail networks. It ties in with automation and scale, which drives cost advantages. They also have a 20% share of global potash capacity, so you have high barriers to entry. But as we will see on the margin of safety side and profitability side, maybe it's just a bad business, right? Maybe you don't have competitors. It's hard to compete. You need scale and everything, but in the end, you have really, really low return investments. From management, um, Ken Seitz, yeah, is a former Potash Corp executive, so he brings deep expertise and experience in mining and agriculture. Current management emphasizes on cost control and shareholder value. I'll touch on that shareholder value on the next slide. And their capital allocation is, well, I think they have like $1.2 billion return to shareholders via dividends and buybacks in the first 9 months in 2025. Right, they have KPI. So I was looking for their incentive structure. What I found in their management discussion report 2023, but 24 maybe the same, is basically they're looking at these numbers, but I didn't find in the annual report like a clear a clear chart or number that this is my key KPIs. These are how they are weighted. This is what management achieved or the CEO achieved. So I lack a bit of clarity on their incentive structure, right? I don't like EBITDA at all, and I don't like adjusted EBITDA especially, right? Because EBITDA is basically you can play with it. It's not a gap metric. Free cash flow is nice. Return on capital employed, I assume nice. Growth, yeah. Safety, environment, okay. Decent but not too transparent. And the dividend policy is to aim a stable growing dividend while balancing share buybacks and growth and reinvestment. So that's the narrative. If you look at their capital allocation outlook, you see that annual capex, what it's going to be. So 23.6 targets, 2.2 to 2.3, and 2.2 for 24. So this one for the 20 is from the 2024 annual report, and this is from the Q3 report. So this was their target for 26, and these are actuals for 24, 23. Let's see how they are tracking year to date. So year to date, okay, enhanced share repurchase, yeah, capex. So you see capex is at 1, 2. If you multiply it by 1.33, what would you get is like 500. So they are tracking below 2 billion. Maybe they will reach sort of a 2 billion range on capex. So you'll see how that turns out. So far, they've been doing less than previous years. Lower expenses, right? Record upstream fertilizer sales volume ammonia, right? So if you have higher volume, your unit cost should come down, everything else being equal. This is their shareholder remuneration and debt history. Okay, so first debt in the red line, you see it's relatively low. So it's below 50% debt to equity. So that's good. As a commodity cyclical business, you have to keep your debt under control. And then you can see free cash flows and you can see dividend and buybacks. What I would like to point out is I tell you every commodity video, what I don't like is when you have the underlying commodity price go up, the stock price of the company that produces that commodity also goes up. And that's when you have also a lot of free cash flow, which makes sense. When the stuff you sell sells for more, you get more cash. And what good commodity businesses do at the good times, they pay down debt and then they pay dividends because they know that I'm not going to buy back my share when it's already really high. Now, if you look at bad commodity businesses, like in this example, Nutrien, what they do is when this is the share price, when the share price goes up, it's usually when the underlying, it's also, I don't have the underlying potash prices and everything here, but if you lived through early 2020s, you know that inflation kicked in 21, 22, 23. So you had commodity prices really high in 2022. You had a lot of free cash flow. Look at this, like $5.7 billion free cash flow. And you have sky high share prices. What do? They buy back stocks at the highs. So this is a clear, amazing example how not to do capital allocation. So I curse the management doing this. Between 2018 and 2024, outstanding shares declined 20%. Okay, imagine if you don't spend 4 billion here for buybacks, but you spend it maybe here. Maybe you just park it in let's say in treasuries, or you pay down debt and then you buy back the stock when it's half the price. Maybe you, instead of 20% down, you would be 35% down. So that's a really bad capital allocation they did. And this is their 2025 guidance. What I want to look at is capex. So we mentioned that 26 they want to do 2.2 billion in 20. Let me see. They did 2.2 in 24, 2.6 23, right? And 26 2.2 Now they target 2 for 25, and we said they are kind of on track to do that. We'll see how that looks like. So they are 2 to 2.1. Okay, I don't like EBITDA. These are volumes, right? Finance cost. It's really high. I'll talk about that in a bit. Effective tax. Okay. What changed, right? What I want to see is their finance cost is coming down based on what they expected in August versus November. So 3 months difference. Capex is same. Tax rate. Okay. Not much. Let's look. This is the good part. So what I want to look at always is I have a 10% required rate of return. So that's my hurdle rate I use to discount here. If I look at cash flows, you see which years were bigger free cash flow, how much capex you spent, how much operating cash you have. And my valuation metric basically uses a year. So this kind of looks like an average okay year, growing 2% annually, compound annual growth rate. Actually, 2018 to 2024, you have 11% on average. I just used um, to project out cash flows. Then the company is worth $30 per share. So I think that's the intrinsic value. And you can put it in perspective. So if you do a 10 what would be my 10% free cash flow yield? Then you would need $28 based on last year. If you average out 7 years, then you would have $46 per share. And of course, in that 7 years, you had a really good year in 2022, and you had pretty decent years since in 21 and 23. And of course, because it's a commodity business, so inflation really started to kick monetary inflation, right? Because inflation is the expansion of the money supply. Post-COVID, you saw huge monetary expansion via commercial banks and central banks partnering together. I'm not gonna explain too much there, but if you look at the M2 money supply expansion, you saw that 2020, 21, and 22, you had huge inflation. Actually peaked in most countries in August 2022. And if you think about from an Austrian cycle theory, that means commodity prices will react faster than consumer prices. So in these first couple of years, you had commodity prices skyrocket without CPI inflation really at the start. So you had your underlying potash price go up without the need to increase your wages and everything because those are lagging. So in these years, you already sell for higher prices without really paying yet the people with higher wages to compensate for the CPI. In the following years, you have to pay for this price illusion basically to adjust the market. So that's when commodity makers, if you have huge monetary inflation, commodity prices, commodity sellers, the cycle starts and you make good money for a couple of good years. Then you catch up, you have a down cycle. That's how sort of it goes. I would say the stock is sort of $30, should be the intrinsic value. And it's not really profitable company. So if you look at the return on equity, 5.7, 9.3 on average 7 years, 2.7 on return on investment, 4.5. So it's pretty bad. Your debt is kind of under control. So the debt looks okay, but the coverage doesn't look okay. So if you look at coverage ratio, imagine like recall in 24, I think they paid around 700 million on interest expenses. If you look at their EBIT, earnings before interest, it covers it 2.5 times. So that's really low. I would want the company to cover it at least 5 times to feel safe. The 7-year average for them is 6.4. That's also not too high for a cyclical business, but the current ratios look fine, above 100. They shouldn't go bankrupt in a year, right? They have leeway. Their cost of debt is not horrible, 6.5 on average, but I'm really uncomfortable with this coverage ratio. I'm looking forward to see their 2025 if they can improve on this, but it's really concerning for me. They have a dividend of 3.85. So if we go back here, you can see dividend here. So they're paying out like 80% payout ratio plus your buybacks. That's your dividend. And of course, it's below 4 because your free cash flow yield, right, is like 5%. So it's not really cheap. So it's not a good compounder, right? Because if it would be a good compounder company, you would have really high return on equity, return on investment, return on tangible, so return on investment in general. So it's not a compounder. It's not predictable, so it's high volatility. So maybe I should use 15% instead of 10% to discount for the volatility, right? So you have not compounder, not stable, and the coverage ratio. So I don't see this as a great business, right? So what are the risks? It's really cyclical, right? You have input costs from energy prices, and you have your own commodities, which are also not within your control on the prices side. So, and of course, I didn't add, but you have operational risks and other when running these operations. So, not compounder, bad profitability. Coverage ratio not too good, and the price follower, yeah, and it's not cheap. Not cheap, not compounder, coverage ratio questionable. So to summarize, really, meaning side, it's a global fertilizer and egg business, right? Leading global fertilizer and egg business with potash, nitrogen, phosphates, retail inputs, right? Business tied to agricultural cycles and fertilizer pricing, so not predictable. And not like utilities or telecom companies or even tobacco companies. So it's essential but highly cyclical. Scale and integrated model and strong potash position gives supply chain and cost advantages, but commodity nature plus weak return on investment and limited pricing power through cycles constrain this mode. So high capex competition means returns are structurally bad. So the business itself is bad. So it's not a bad company to say, but the business they are in is inherently hard. So broad base, but really soft moat, if any, right? If you see a business with good moat, you will see high returns on investment over a long period of time. They don't do that. They don't have that. The team should be experienced. Incentives tied to EBITDA, free cash flow, return on capital employed, safety, blah, blah, blah. But transparency and alignment, not best in class, I would say. Capital returns policy is sound, yet execution and timing is, as I described, you don't buy back shares when your share price is sky high already. Maybe if they would have a clearer incentive structure, maybe we would see something that would make them do it, right? Maybe they have options and then they want to push stock prices higher that time and cash out. So that's something that could help us to understand why would they destroy shareholder capital that way. So it's relatively competent with experience, but weak alignment, weak incentive structure, and questionable capital allocation. So you have a dividend of 3-4%, free cash flow yield around, I think this is, where is this, Nutrien? Yeah, you have these returns, right? And you have like a 5% free cash flow yield over 2024. So its valuation is high. You have a 2.5 coverage ratio, which is very concerning, right? I don't want to really see my company to only cover free cash flow 2.5 times, especially if you're a cyclical business, like you are playing with fire. There is no margin of safety. The business is not a compounder. So price is high, business not too good, and your debt coverage is questionable at best. Right. That would be it. If you enjoyed this video, please like and subscribe, and let me know in the comments what you think, if you have a company that I should take a look at. Take care, guys. Cheers.